And we really appreciate being here. It's great to partner with these folks. We are if you have the event app, there's a place in there to put questions. And the idea is that if you'll share your questions as the session goes on, we can collect those questions. Lisa, because she never gets a break, is going to look at those questions, edit them, put the related questions together and such, and pass them up here to me so that we can get your questions in front of these folks all through the session. I want to welcome you. This is a topic that is so important to everybody, and we're going to find out in this session, I think, important people aren't thinking about it yet. Two fabulous people with us to talk about this topic. Valerie Brown is the Deputy Executive Director at United Policyholders. We're going to ask her to explain that in just a minute. You're also on the Consolidated Plan Advisory Board for the City of San Diego before. I want to talk about that. I'm especially interested in your on-the-ground work with people who are affected by disasters, right? Which is very, very hands-on, very supportive in the moment that something happens to you. Dr. Lloyd Dixon is a senior economist at the RAND Corporation and the director of RAND's Center for Catastrophic Risk Management and Compensation, which is why his name tag looks like it's got a paragraph on here. Look at that. And he defies the Bay Area college war by having a undergrad degree from Berkeley and a PhD from Stanford. Let have it, whatever you think. And he is somebody who is fascinating because he's looking at this as an economist, as somebody who's looking at the big picture and not just about fires. We'll talk about his broad experience doing a lot of different things. Valerie, I thought I'd start with you and ask you to talk about United Policyholders, not to make the pitch for it, but what is it that you do and where do you encounter people who are having these problems with, among many other things, not having housing fire insurance?
Yeah, so United Policyholders, we're a small national nonprofit based in California, up in the Bay Area. And we started with a concept. So we had a whistleblower from State Farm who was looking at the Loma Prieta earthquake, determining fraud had happened with insurance companies, specifically with State Farm, obviously, paired with my current ED, who was an attorney who worked with plaintiffs on insurance issues. They realized there was a problem. They were working on, there ought to be a nonprofit to help people with these issues. And then the Oakland Hills wildfires hit in 1991. So fast forward, we immediately stood up a program called Roadmap to Recovery that exists to this day. And what that does is provides really practical, hands-on guidance to people to how to navigate the insurance claims process, because it's really complicated, especially when you have a total loss and you're juggling all those pieces. A kitchen fire is one thing, a total loss with my foundation needs to be ripped out. I need to list everything that I ever owned in my home. I have to deal with building code upgrades, and my building department doesn't know how to help my contractor with that. It just gets really complicated. And so from that concept of the Roadmap to Recovery, we've ended up with a program, three programs that cover all facets there. So we work with disaster survivors on that practical how-to, you can get through this. And we lean very heavily on volunteers who are previous catastrophic loss survivors. So my community burned in 2007. Policyholders came in. That's how I met them 15, 16 years ago. They brought in the Cedar Fire folks from 2003 in Scripps Ranch, who were mentors for our community. And it's those volunteers of, I did this, that we just sent a bunch of people from the 2017 Tubbs fire to Maui to help those people in that wildfire, right? So, but back to the three programs. So the Roadmap to Recovery is what happens after disaster, helping people through the insurance process. The Roadmap for Preparedness, which is the space that I'm here today, is what people wish they had known before they had a loss with insurance, so that if they have a loss, they're adequately insured and they can get moving on their lives much faster. And the third one is called Advocacy in Action, and it's where we work with regulators and legislators and disaster survivors to improve the protections for consumers on insurance issues. And that's basically in a nutshell. One other thing, I am also the San Diego County VOAD, Voluntary Organizations Active in Disaster Chair. So anytime there's a disaster in San Diego County, I'm point person for that. It has nothing to do with my day job. It's just a volunteer thing that I do.
So you often meet people on maybe the worst day of their lives, one of the worst days.
One of the worst days.
Through one of the most challenging things. And you came to this for your own experience.
Yeah, my community burned in 2007. I live in Rancho Bernardo. And I was, I think I was a volunteer for about 3 days. And then the San Diego Foundation came in and hired local long-term recovery coordinators. I did that for about 3 years. And United Policyholders came into my community because of those Cedar Fire folks that I mentioned. They brought in that program because that's what helped them get home. And so I met UP and ended up liking them so much that I started volunteering with them. And so their ED would call and say, hey, do you want to drive to Lake Arrowhead? There was a fire there in 2008. Can you help the Department of Insurance with a workshop we're doing?
That's amazing.
Yeah, and just go wherever. They put me on a red eye to DC one time to do a conference with FEMA. It's like, I'll go wherever. 4 years ago, I ended up going on their staff.
That's amazing. How many people here how many people own a home? Let's start with that. How many people have opened an envelope from an insurance company in the past couple of years, had a minor nightmare? Yeah, it's real, right? Lloyd, you're an economist who looks at catastrophes. You're a professor of catastrophes, right? And it's fascinating hearing you talk earlier about some of the things that you've looked at. This is not unique to fire. This is not unique to wildfires. There's a range of risks we have as humans in a built environment. I would love to hear you talk just a little bit of the background, some of the other kinds of disaster impacts you've looked at, and are there themes that are the same among all of them?
Well, I think I know. First, pleasure to be here. Nice to be on the panel. I think a theme of what I've looked at a lot is the appropriate public-private relation, public-private partnership of insurers and the government addressing some of these risks. So in some cases, the insurance market is just not well suited or just doesn't have the tools, the capacity to deal with certain types of risks. And you need some kind of government involvement on some level. So I got started in insurance probably it's sort of around 9/11, really. So we looked at the role insurance played in compensating victims from 9/11. And then soon thereafter, just sort of by coincidence, I did a lot of work on the National Flood Insurance Program. And so there's an example where flood, private market wasn't interested in it didn't have the type of characteristics of risk that they were able to insure. So we set up a government program in that case. So, what I've been looking at is, the strengths and the weaknesses of the public sector and the private sector, and how they can work together to create a vibrant insurance market. So in the case of so I'll talk about earthquake for 1 second. I'm on the California Earthquake, a designee to the governing board of the California Earthquake Authority, and in that case, after the Northridge earthquake, insurers did not want to provide earthquake coverage anymore. And we could go into the details of that. That caused a lot of dislocation in the housing market. And so we set up the California Earthquake Authority. In this case, in the wildfire case, what's been happening is, from the insurer's point of view, they just aren't able to have the flexibility to charge the rates they need to make it attractive to them to be in the state. And so you've seen over the summer, over the last year, the headlines about many insurers withdrawing, State Farm saying, we're not going to write any new policies, farmers limiting the number of policies, USAA saying they're not going to write new policies. And so, we've been looking at some of what are the reasons for that, what are the implications for that, and, what can be done about that.
Yeah. I was looking back at your background, we were talking about some of the stuff you've worked on, hurricanes and the impact of the pandemic. And the latest one you talked about was landslides in Alaska. That's right.
Yeah. The Southeast Alaska, they're just the way the topography works. It's, the ocean, and it's just really these steep mountains that are relatively recent volcanoes, and they have all this ash on them. And when it rains, which it rains there a lot, it gets wet and it causes landslides. And they've had a lot of homes lost, deaths, and there's really no landslide insurance. And it's kind of comparable to the lack of flood insurance. And so we were looking at, from the Alaska state's point of view, what could they do to sort of create some availability of landslide insurance.
Here in California, equal opportunity about disasters, right? Yeah. Landslides, earthquake, pandemic, fire, we have them all.
That's right.
And the hurricane last this year, right? I mean, we haven't had that yet in our lifetimes. Let's talk a little bit about the underlying economics here, right? I think we all buy insurance and we sort of understand that we pay some money for insurance. We usually don't get anything back for it, but it goes into a pool and the person who needs it gets it. Is it that simple? how do we understand the insurance business? Because we get these, and we don't pay attention to it until you get that bill that is stratospheric, or worse, you get that notice that we're not covering you anymore. You got to go find another insurance. What do we need to understand about how the insurance business works to be good consumers on that product?
Yeah. So just no. I'm not going there. So one of the first things that assumption, that's a fallacy, that the premiums that we pay cover those claims out. So I believe last year it was, I think it was nationwide stat, it was 104% payout. So 4% above the premiums collected. And through quarter 3 of the current year, I know it was at least 120% above so 20% above premiums collected at that point.
So they're dipping into whatever reserves they have or
exactly. And the more, and just in case you don't watch television or read the news, we're having more disasters and more large scale disasters and catastrophes across the country and across the world. And so those one-off events, when Cedar Fire happened, that was considered a 100-year fire. That does not mean what you think it means. It just means the odds are, right? So we had another 100-year fire 4 years later.
We think those odds, right?
Yeah. And climate change is driving some of these things. Our environment, we're building out into areas. So that's that piece, right? Risk is increasing because more people are living in areas that are risky to live, but we also have to have places to go. And the other piece with insurance is, there's this sense of entitlement. I've been paying them premiums for 30 years. Why are you dropping me? It's not personal. They are a for-profit business and they have to balance their portfolio. And that includes looking at the risk, and risk is increasing.
Yeah, I would so just add to that. So, oh, sorry. Yeah, sorry. I thought it was.
Angle up, yeah.
Does it? I don't think it's.
The mics want to be in it with your face.
Maybe. Oh, there we go. Okay, there we go. Yeah, I would add to that. I think what you're looking for in the market is risk-based rates, so that the rate, your premium you pay for your insurance is based on the risk of your property. Think of the expected value, like over the next 100 years, what's the chance of different losses, and you want a premium that reflects that. So with wildfire increasing due to climate change and other factors, risk has been going up, rates are going up. So, that means insurance is expensive. And from a social point of view, that sends a good market signal that maybe people don't want to live in those, we don't want people to build in those areas, that, it sends a signal about the risk of living in a certain area. Now, the problem is that it creates, some real affordability problems for people who have lived in those areas for a while. The risk goes up. They used to be able to afford it, and now they can't. So that's a real social issue. So get to that in a minute. But overall, as far as the functioning of the market, I think it is appropriate that we want premiums to reflect the risk, and for a number of reasons, which means insurance is going to be expensive. That's in some cases in certain areas. So,
is the primary reason that we're seeing so much higher premiums is because there's more risk? Is that all climate change?
Well, I think it's both. It's California did this fourth climate change assessment not too long ago, or 3 or 4 years ago, and looked at the effect of climate change on wildfire risk. And there's definitely a upward swing in the wildfire risk due to climate change. So there's no question about that. And then also expanding population. People like to live in pretty areas, so you've got a lot of population growth in the risky areas. So I think it's both.
Well, and the other thing to factor in there is that, like during COVID, when we had so many fires in the West, just too many fires in the West, building materials and labor just went sky high, and so. While there were a lot of battles, people had to be paid out to get their policies paid to rebuild. Those insurers absorbed that cost. And that's not something, a pandemic clamping down on labor and materials It's not something insurers would have ever baked into their modeling, if I can be very blunt, and maybe Lloyd has done that, but I wouldn't have expected that.
Well, the other thing too is after a big event where there's huge demand on the construction sector, it makes it worse, right? It just
The larger the disaster, you
Yeah.
have a surge, and insurers cover that with something called that extended replacement coverage. That could be 5%, 10, 20, 50. I've seen a policy that was 100% additional. But, we as consumers need to understand it's meant for that surge, because 1,000 homes, 10,000 homes were lost in an area, and you're battling for resources, and you're having to pay extra because you're bringing people in from different areas to do the work. Materials are more costly. It's not meant for the world shuts down.
And that's another thing we've seen that didn't used to be the case, right? That losing dozens of homes, hundreds of homes, Paradise, the Tubbs fire, the volume of homes that could be lost at once in a fire that is bigger and longer than before. Right? So another factor.
Yeah, right. They call that demand surge. After the demand for construction and materials demand surge.
That sounds like a horribly sterile term.
Yeah, right. Yeah.
You mentioned Northridge, 1994 earthquake, and talk a little bit about the effect that had on housing in California, because it was devastating what it did the day it happened, but the knock-on effects were long.
Yeah, no, at that time, insurers were required to cover earthquake in the homeowner's policy. So, or to offer coverage, for earthquake. And so, but given the size of the losses, insurers just didn't want to do that anymore. And so what happened is that it really caused a problem in the housing market. So people who needed to get loans and buy insurance weren't able to. The insurers weren't willing to offer any insurance, whether it was earthquake or not, because they didn't want to also have to offer the earthquake. So there was a big economic effect, and then that's when the California Earthquake Authority started. I'll just say that totally similar situation is after 9/11. The insurers in 9/11 terrorism was included in business insurance policies. And so insurance paid out a huge amount of money in 9/11, billions of dollars. But insurers no longer wanted to do that. And that caused a reduction in certain construction projects and that in certain areas. And so that was really the similar impetus for the National Terrorism Risk Insurance Program is what we have. Yeah.
So you mentioned the California Earthquake Authority. How many people here own a home and don't have earthquake insurance? Let's be honest.
Right.
Is it because of the cost? Or is it because it hasn't occurred to you? We don't know enough about it? Cost?
And what you get back.
The deductible is
The
too high.
deductible is high?
Yeah.
And what you get back, meaning if there's no earthquake, you get no money back?
The deductible takes it like.
Right.
Yeah, the deductible might be 15%. So it does feel costly, sorry.
I don't want to put you on the spot, but since you're on the board, help us understand what we're not understanding about CEA.
Yeah, that's a really good question. Yeah, the deductible, you can have a $50,000 deductible, easy for these things. And so the CEA is in a real bind right now because in order to protect itself and have the money to pay policies, it has to buy a lot of reinsurance. And so reinsurance is what insurers buy to protect themselves. So it's a reinsurance market. So CEA is like the largest buyer of reinsurance in the world. The single largest buyer buys I think it's like $12 billion of insurance every year. And the cost of it is just going up and up. So what happens is it can't afford to provide the cost of providing full coverage is just huge. I mean, it's just enormous. So the only way you can in effect ration this limited amount of reinsurance is to have these high deductibles so that no one household can suck up all that reinsurance capacity or a significant portion of it.
For you as a consumer, if you do have earthquake insurance and you're wanting to protect yourself on that deductible, there's a new tool out called parametric insurance that can cover most of that gap. Jumpstart, I think, is one of the providers. So there are some tools for that, but I have earthquake insurance, and I also have a home in Rancho Bernardo it would be very expensive to rebuild. And my premiums were creeping up. And then I realized when I did the math that I wasn't actually adequately insured. And I don't have $500,000 sitting in my bank account to help rebuild my house. And I know I'm paying for the risk of, they say lightning doesn't strike twice. I don't believe that anymore. So even though we had a fire 16 years ago, I am insured as if it were going to happen tomorrow. And so what I did is when I raised I more than doubled my amount of coverage. I added earthquake insurance. I raised my premium from $2,500 to $5,000. My premium now is $200 more a year than it was prior. And I'm going to put it in context for folks who are born and bred Californians who've never left the state. I have insurance on a house in North Carolina, little home. My premium there for a 1,100 square foot house is half of what I'm paying here. I have a 2,800 square foot house here, much nicer house, much more amenities. And my coverage is still, as Lloyd was saying, does not reflect the risks that I have here. So while for us, going year to year, looking at what we pay and what our budget is, we're still one of the more competitive insurance markets for consumers.
Yeah.
You started to say 28 square foot. I would have believed that in California, right?
I have a closet if anyone would like a place to rent.
It's on Airbnb. It does raise the question. Like, so many people just said they have a home, they're not on the CEA plan. We all get the piece of mail every year encouraging you to do it. It's not like nobody's ever been asked.
Right.
How do we get over that mental hump to say, okay, I guess I need to do it now, I'll do it? It's a math you did?
I would say it's the math, but the other part is, knowing your risk. And then, especially in communities, one of the things CEA does, and they have different grant programs to help do mitigations to help, bolt your foundation, things like that help. Those are things that could potentially be driving a discount on insurance once we get mitigations recognized for wildfire and these types of things, just like you see with the fortified homes in the hurricane-prone areas. If you have the roof that will withstand winds of a certain amount, you're going to get a discount on your insurance.
Yeah, CEA has if you mitigate your home, like brace and bolt it. First, they have a program called Brace and Bolt that provides grants that you can go on their website and there's you can sign up for that, and there's a waiting list. But there is a program. But if you do mitigate your home through bracing the foundation, bolting the foundation to the structure, you can get a 15-20% deduction in your premium. So, but still expensive. But at least that's a way. And I think that brings up a question or a point about earthquake and wildfire, that mitigation is the best thing. That's the way to reduce insurance costs. In the case of wildfire, it's complicated because it's not just what you do on your home; it's what the whole area does, and it's just the topography.
You won't clear the brush around their house.
Yeah, exactly, and it's the whole community. And as we were talking about before, wildfires get so large it almost doesn't matter what you do, right? In certain circumstances. So, but mitigation is, that's an important tool in all this.
And that mitigation works. Everyone's seen the picture from Maui, the one house that was standing, and they had not done a lot of mitigations, but they had started with the ones they could handle. A lot of them were low cost. It was that ongoing maintenance, clearing the debris around the house. They had swapped out their roof. They had done a couple of things that made a huge impact for them in a wind-driven wildfire situation. I'll be frank though, you can do all the mitigations and it doesn't matter. If you left the window out, you're out grocery shopping, you can't go in and close it, your house might burn from embers blowing in. There is no 100% solution. All we can do is increase our odds. Right. And the mitigations are really important.
Calculating the odds. It's fascinating to hear you, Valerie, talk about the robust insurance you have, given that you spend so much of your time on the ground, face to face with people who just have this worst day of their lives, right?
Yeah.
Talk a little bit about what your organization does, what it's like in the situation where you first go into a place where there's just been a fire.
Yeah. So I as I mentioned, we've sent staff and volunteers out to the Maui fire. I haven't been out yet. So the last deployment I had was for the Marshall fire in Colorado. So that was the 30th, so New Year's Eve. or day before New Year's Eve, sorry. And people were out shopping, and then suddenly within 3 hours, their homes are destroyed. And so I flew in. I think I was there the second day after the local assistance center opened. And it's just mind numbing. And so people, we all think, because of the advertising, we think that our insurance company is going to treat us like a friend, a neighbor, right? We've heard those jingles all our life. Advertising is really good. That's why they use these terms. And so we think that we're in a friendly relationship, and we might have that friendly relationship with the agent, but the other side of the house, the claims handling side of the house, is very much process driven. They have, their book that they have to follow. And no matter what the agent says, no matter what you ask, they have to follow their process. Think of it in quality assurance terms, right? They have a process, they have to do it. And that's really hard for people in a total loss or a partial loss to have that realization hit, because what you want and expect is people just to wrap their arms around you and make everything as...
And give you a big check.
Yeah, give you a big check, because remember, you've been paying these premiums for 30, 40, 50 years. And so that's really hard for people to see. And what was always shocking to me was talking, like I had someone in a condo association, and he realized he had enough, he'd lost his home. He had enough additional living expenses to basically rent a place in Boulder County for 4 months. They have a season, a time of the year where you can't pull a permit because of the weather. So they only have like an 8-month building season. He was underinsured. So he was not going to be able to build that first year entirely because it was going to take him that long to settle his claim. And when the realization hit of the math, he was just ready to declare bankruptcy, walk away. And that's really hard. And that's just the math of rebuilding the home. That's not the reality of the inventory. Because if you have that loss, if you read your policy, and that's what I'm talking about, the fact that people don't read their policy, and I know it's odd.
To be read.
Well,
That's true.
let's talk about the logistics of the policy, right? You get your policy after you buy it, right? So you're not comparing apples to apples. You don't know what you're comparing. You're stating your wishes. You're working with an insurance company. They have their a la carte menu that you're shopping from, and then you get the package, but you don't know the terms. You don't know how you get paid, what that looks like, all of that stuff, right? That's all in their playbook that the adjusters handle. So you're looking at that, and you don't even know how to do the math, just to be frank, right? Can anybody in the room tell me what the cost per square foot is to rebuild a home in San Diego County that's a one-off, that has a wildfire damaged foundation, and it's not a custom home, you're a track home, so you would have insured to be a track home, but you're in effect doing a semi-custom home.
I really understand the question. Right?
This was my world in 2007 that I got thrust into, because fortunately for my community, 85% of the people in RB Poway and Escondido and Rancho Santa Fe had insurance. 75% of them were underinsured by $250,000 or more. But 85% of them had insurance, which meant they could replace their home.
Is that high compared to other communities?
I would say, like, for the campfire, less people insured, a lot more retirees, because that's one of the things that falls off when you quit. People always get in trouble for not paying their property taxes when their mortgage goes away, because you've been on autopilot for 30 years. You don't think about the fact you've dropped your insurance because you didn't make payment. And especially if you're they're set up to go to you. And if you just look at them, you're like, oh, I get this deck page every 6 months. I toss it in the pile. You never open it to see it's a notice for payment, right? So it's really easy for people to fall off. And a lot of retirees make that budget decision of, I can't afford insurance because of everything else. Property taxes are going up, all of these things, cost of living. And so when you're juggling, that's a calculated risk decision people make, that maybe I can't afford it. But what you can't do is not afford to replace your home if you're a homeowner. So going back to what it looks like when, with the people that came in. So there was the fact that to claim the dollars for your personal belongings, your furniture, all of those things, you have to provide a detailed list. They want to know what you owned, when you bought it, where you bought it, what price you paid, and what condition it's in. I can't tell you what's in my junk drawer, much less my closet. I do this for a living. I do our contents workshops. So did anyone know that the average American male owns 37 shirts? Do you know how much 37 shirts cost? I don't either, because I don't know where any of you shop. And that matters. It might be a $12 shirt. It might be $120. It might be a $1,200 shirt. I don't know. And because it's individualized to you, you have to go through that and put that information. And it's just re-traumatizing. It's just a very bad position to be in.
So do you help people through that?
Yes. So we do our educational workshops. We have a group called Survivor to Survivor with previous disaster survivors that provide that emotional and mental support to help people through. I do pricing parties for that kind of thing. We do pro bono legal clinics for people. We do pro bono financial decision-making clinics, because when you look at your gap, remember that $250,000 gap I was talking about in 2007, where are you going to come up with that money? What if you don't qualify for an SBA loan? Because remember, SBA will loan you, my fire, it was $200,000. And now it's $500,000, which is amazing. But it's a loan, 2.9% interest. You have to qualify for it and you have to be able to pay it back. You can't get a HELOC on a house that's destroyed. And
And some people,
and the other part is that you don't want to pull money out of your 401k. Don't jeopardize your long-term financial future to replace that home. You might be making a really hard decision of, is this when you're building that ADU with your kids that you were thinking about doing in 5 years? Is this the time you move closer to family because you can't afford to rebuild in California? That's the kind of sidecar work we do at United Policyholders.
and I'll just add in some cases, I think people, don't buy earthquake insurance because, figure FEMA will be there in some way or another. But, first, there's the SBA option, but that's limited and it's a loan. And then FEMA aid is limited. It's, I think what the maximum is 30.
It's 41,000 now.
41.
41,000. And that's, Congress requires something. There's no duplication of benefits under the Stafford Act. The average award is $5,000. And if you have insurance, you have to prove you have a gap insurance that is under the $41,000 of their limit. So if you got $85,000 in insurance, you're not getting any money from FEMA because you've already exceeded the benefit, because their job is not to make you whole. It's to provide a safety net to help people get moving forward. Insurance is what drives community-led recovery.
I see a hand raised boldly. We'll take that and break our timing on questions.
I just wanted to know that the question you didn't understand that Valerie asked, if she could answer it. How much?
Oh, you want to know the answer? Okay. So for a 2-story house in Rancho Bernardo that has a very simple foundation, and my house is on rocks, so I'm not pylons. I'm a simple foundation for a 2-story house, and he's laughing because he knows I'm being very qualifying here with earthquake stuff. It's about 375 a square foot as of 6 months ago when I renewed my policy. And I will be really frank, the first time in 08, when I increased my coverage, my insurance company accused me of planning to commit insurance fraud because I more than doubled my coverage. And to them, that hit the fraud alert of, what is she planning to do? And why would she do this? Because people do these things. You've seen it in the news. People take out a life insurance policy on a spouse, and then the spouse dies. And then there's a dramatic court hearing and all of that stuff. So for them, kudos that they're paying attention, right? And so I had an argument, and now my file says give her whatever she wants, because I had an argument with their CEO, and so my file is flagged, and I know it's flagged because they tell me I still flag it.
But
Yes.
not all of us have access to the CEO of the insurance company. Right?
Well, and nor should you. So when I went and renewed this time, it got interesting because remember, your insurance, your property and casualty insurance is the cost to repair or replace your home. It's not based on your tax value of your home. It's not based on what somebody would buy your home for in the real estate market. Apples, oranges, pineapples, right? And what's interesting when you're talking to your insurance company, like for me, just full disclosure, I have USAA. I went above their $1 million threshold for insuring. So I had to go to special claims underwriting, which was fine. Special underwriting, sorry, no claims there. First she was balking at doing it, and then she pulled up Zillow and she's like, "Oh, your house is worth more than that. We're fine." And I'm like, "But it's not apples and pineapples. Your job as an insurance company is to insure me for the cost to repair or replace my home, not what my house is worth on the real estate market." And so, again, a little education opportunity with the insurance company.
Thank you for making me smarter. So $375 a square foot for your 2,800 square foot home, which is over $1 million.
Yeah,
Yeah,
my house is worth more on the real estate market than it would cost to rebuild it. So obviously, if we had a wildfire in Rancho Bernardo tomorrow, I would prefer to sell my house before the wildfire comes. Right? But, well, then there's taxes. Never mind. Maybe not.
Wildfire, no.
There you go.
Wow, fascinating. Let's talk a little bit. Sure.
I'm trying to get on the thing to answer questions. Do pictures of the interior count?
You would want to have documentation of whatever you can provide. So let's just be frank. When you're evacuating, don't depend on a file in your house. You may or may not remember to take it with you. Have things in the cloud, store with another relative. Photos of your finishings and fixtures. If you do an addition on your house, you want to not only document it for yourself, you want to share that with your insurance agent, because if you've done a renovation or an addition, that should increase the amount of insurance you have. But for your contents, that video, photos are great. But again, they want more details than you're going to have. So I would tell you all from this point, my challenge to you is set up a throwaway email account that you have the credentials to get into. And every time you make a major purchase, when they ask you, do you want to print or email a receipt, have them email it there. And start from this point doing that. And when you make major purchases, or if you, like I'm old, so I have that, my file of like all my warranties and appliances and all that my purchase prices, because my husband's that person. And so I maintain the files. I went back and scanned all of those, and I have those on the cloud in that email account. But that's only a piece. That's not what I buy every day.
Sure. I've got questions here that just take about another 3 hours to get through with all the stuff to talk about. The app does work for Q&A. I've used it. I know some people are having trouble with it. But here's the instructions here on how to use it. Lisa's been fielding those questions, and we have some good questions coming in. One of the questions is, how will the insurance companies pulling out of California affect renters? And what is that? If I own a house, I know the insurance companies pulling out means I'm going to have trouble getting insurance. Does it matter for renters? What does it mean for renters?
Yeah. Renters are actually, depending on the area you are, they're even having a hard time finding renters insurance. So we have a survey on our website that I encourage all of you up here. I've got it here. Whether you're a homeowner or renter, please fill it out.
Pass this out.
Yeah. But we've been running a survey since 2017, year to year. And what we're finding of the people who are dropped, 65% of the people that take our survey have been dropped. And the other 35 have had their premiums increased. Basically, they're reporting one or two of those things. The most common reason, 60%, it's location. Brush around the home, thinking wildfire risk that we're so conscious about now, is about 17%. So location is that driver, and that's where renters are finding they're getting dropped. One of the interesting things, and this goes back to what Lloyd was talking about, because the California Earthquake Authority not only has a mitigation program with grants, but they also provide you a discount, right? So they tell you what to do to protect your home, and they provide a financial incentive in the terms of grants, short term to help you do the work, and then long term you get that premium discount. But what we found with the wildfire specifically over the last 6 years is that 90% of the insurance companies didn't provide a reason for keeping the steps people could do, those mitigations, so they could keep their policy. And that's what we're getting into today, is the idea that we need government doing their part to protect our open spaces, to provide these grant programs for mitigation. We need homeowners to step up and do their part to protect their properties, but we also need the insurance companies to be a partner and recognize the work and be proactive in this.
Yeah, two comments on that. So first, on the how it affects renters, it will also, the landlords' insurance payments are going to go up. So I mean, so that could, end up getting translated into rent sooner or later. So there's that component as well as the actual renter for their personal property on the home, which the take up for that's not real high, right? I mean, there's not very many. I haven't actually looked at that, but I know looked at that in the flood insurance program, and they sell very few rental policies in the National Flood Insurance Program. So that's a gap in coverage that people have.
But those landlords are getting the same letters we're getting and saying,
Yeah,
exactly.
or we're dropping you. Yeah. And for renters, it's even more imperative because they're not going to get, I mean, they're going to have to fight for whatever they get from FEMA. Remember that average award is about $5,000, which might be your first month's and your first month's rent here. And I don't even think that's adequate San Diego rates, because my daughter was telling me it was $3,000 a month to rent a studio here. But all of your belongings, if you have a family member or you are a renter, it is literally, you, depending on the size of the policy you want, it might be the equivalent of the Starbucks coffee I had this morning. $5 a month will buy you much more coverage than you're going to get from a FEMA award.
You're a better insurance salesperson than most insurance salespeople.
Well, I know that's odd to say, I work with a consumer advocacy group that helps people with insurance, but we all want a very healthy ecosystem where the work and the risk is shared so that the system works. Because right now we've got homeowners who can't sell their home or buy a home because they can't find insurance.
And we're hearing that not only from, we're hearing that from wealthy people. We're hearing that from well-known people. Like, it's not about the amount of money. Somebody's asking about the way to do the kind of calculations you were talking about the cost to replace your home, cost of insurance and stuff. Is that available for the stuff that you're sharing?
No, it's all going to be anecdotal, just to be frank. So what usually happens is in a disaster, you're going to hear of people in the community who are rebuilding, and they'll be able to tell you what their price per square foot was on their contract. And that's where you're getting a lot of it. Because I've been working the last, I guess, 6 years now in Southern California on wildfires. I have a pretty good feel for what the rates are.
It's all you.
The rebuilding rate.
So for practicality purposes for all of you in the room, it's not going, when you Google it, you're going to see the same rate that FEMA and SBA, and it seems like the insurance companies all use, is it looks like it's $150 a square foot. What's the cost of new construction in California? That is looking at thousands of homes and tract built, and those are master plan communities, very low cost compared to building a one-off home. So you could, if you're friends with a contractor or one, you can ask them what they're looking at for it's not a custom home, but it is truly a semi-custom build because it's a one-off.
So something like your $375 times your square footage in the ballpark.
Yeah, that's close enough for me. I know I would still have a gap, but my gap is manageable. I'll just scale down my house, Well,
also, isn't it the case that all the insurers now are required to give you a replacement cost thing every 2 years? I think that was a law that recently passed.
So on your statement, you'll see that there's a calculation. And I know it feels the exact opposite of how it should be, because you're not a construction professional. You don't know how to build houses. You don't know how much it should cost. They're the professionals who are paying people out. And you would think that it would be their responsibility to adequately insure you, but especially in the state of California after the Everett versus State Farm case in 2007, the courts decided that you as a homeowner are the person responsible for setting the value of your property and casualty insurance, not the insurer.
That's true. But now the insurers are required on request to run their model for you, their replacement. So you can call up your insurer and they are required to give you an estimate of your home.
Right.
I think once every 2 years.
Right. And that typically they use a system called Xactimate that while it's supposed to index to your zip code, it usually is, this is just anecdotally from seeing thousands of cases in the last several years, it seems to index about 20% lower. It just is not as precise as an actual builder's quote.
Sure.
and even from cost of materials. But it is a really good gauge. I mean, if you took it and got it from your insurance company and you said, I need a little more, that's that extended replacement coverage we were talking about, right? If it costs more, you've got that cushion to cover it.
Lloyd, with your economist hat on for a minute, the insurers either refusing to do new coverage or actually pulling out of the state of California. What does that do to housing production and the housing that we so desperately need in California anyway? How much of an impact does that have on new housing?
Yeah, it creates an issue. First, it creates an issue for the existing market in the sense of when people sell their home, the rates, increasing rates, the new buyer presumably will realize that those high insurance rates and will not want to pay as much for the property. So, it does decrease the current property values. And also the lack of availability and coverage and the increased cost just adds to some of the barriers to building new housing. So I would say that, as far as the health of the market, the reason the insurers are pulling out or withdrawing or reducing their coverage is in their view, they're not able to charge the rates that are appropriate. And there's a number of reasons for that, things that they think are getting in their way. And, we can go into the details of that, but there's 3 or 4 regulatory aspects of how the insurance companies are regulated in the state that are affecting them in a way that makes it not very attractive to write coverage in the state. So, one of the things recently that's happened is there's been the insurance Commissioner Lara, and he recently, a couple of weeks ago, announced some reforms where it will give the insurers a little more flexibility in getting rate approvals to increase the rates. So that means the rates go up. Now if you live in a low risk area, if you live in a highly urbanized area with no wildfire risk, your rates may not change at all. Which is appropriate.
That's not where the new housing is.
Yeah, which is appropriate. You don't really want the low risk areas subsidizing the high risk areas. So they might not see any areas, but one way. So what do we do about that problem? Is there, what do you do about that affordability issue? Well, one thing that's possible is to set up a kind of affordability program. So for example, in the Affordable Care Act, in the health area, really high risk people for their health insurers are in effect subsidized in their healthcare coverage, and so you could think of a program that was created that provided assistance for high insurance premiums to certain families or certain people who really needed it. You wouldn't want to provide it to everybody because you don't want the high income households to benefit from a kind of a program like that, but that's a possibility. So the National Flood Insurance Program is Congress directed FEMA to consider a program like that for flood insurance. And so that's possible, but who's going to pay for it? You got to set it up, figure out who qualifies for it. But that's a potential because rates are gonna be high in certain areas, and there's really no way around that. I don't think.
Let me ask one policy question for a minute. Should the city of San Diego, should the county, should other municipalities be restricted, be stopping building in high-risk areas? And would that actually address this problem and lower rates?
Right.
I don't think restricting where without protecting what's already there is going to move the risk, because the risk is already there.
I mean, I'm generally of the mind that as long as the insurance premiums reflect the risk of building in a certain area, fine, go build there, but you've got to pay for the risk to be there. So, that's been a big debate in many insurance, but particularly in the flood insurance program is like,
So
should
rates have to reflect the risk,
Yeah.
which you're an economist.
Yeah.
That's the main
I'm gonna say that.
Right. No.
Yeah.
But if an insurance company won't give me a policy on my home,
You're going to go to the California Fair Plan.
Let's talk about the fair.
So the Fair Plan is the insurer of last resort in California. I know everyone hears the horror stories about it, but it's only about 300,000 policies in the state as of the March numbers that I have. So it's not a lot of people who are on it, but those premiums are going to reflect the risks. So that's when you're hearing people talking about $12,000 a year premiums, that's that they're under the Fair Plan. And so what's interesting is the Fair Plan they've embraced what Lloyd said. They're offering those. If you do mitigations, they're going to give you a substantial discount. So I believe it was just approved with the Safer from Wildfires, the press conference that the insurance commissioner had. So they're offering for, if you do the mitigations that have been identified as protecting your home more from wildfire, your home, you're going to get a 10% premium discount. If you do the more maintenance issues on your landscaping, the home site, you're going to get an additional 5%. And part of that is you're going to pay for the risk you've got. But if you take these steps, what I heard recommended was if you'll take that discount and plow that into doing the mitigations on your home, keep doing mitigations on your home and property, you're going to end up, as you handle those things, being less risky to insure, and you should be able to go back into the more reasonable pool. I don't know that that's going to work, but that's one of the strategies I heard last week at a conference with CAL FIRE.
So we talked about last week, there was a whole series of debate in the legislature this year about a package of reforms that didn't happen, right? And then the insurance commissioner came out with something a couple weeks ago about what they are going to do, or at least try to push through the legislature.
That's right.
Right.
That's right. Yeah. So it couldn't get through the legislature, and I don't really know the nitty gritty of what held up some agreement in the legislature. But in the end, the insurance commissioner said that the Department of Insurance would in effect do most of the things that were on the table for the legislature. And the question is, exactly, does the insurance commissioner have the discretion to do all of them, or does he need some kind of legislative approval? But yeah, that's what are
the chances when the insurance commissioner does something that actually happens without lawsuits and everything else? But then the general premise there, right, that they're going to allow insurance companies to raise our rates as long as they keep doing coverage in high risk areas.
That's
right.
right.
So you're going to have to pay more, but you'll still have to get coverage, which sucks. Maybe sucks less than having to go on the Fair Plan, because the Fair Plan, it's not just sort of an unlimited thing that'll take whoever falls off insurance, right? Eventually, doesn't it break at some point?
It will break, and it's also it's not a comprehensive property and casualty policy. It doesn't have your liability, your ALA, your additional living expenses. Sorry for the acronym. It may or may not have your contents. So you usually have to pair that with what they call a difference in conditions policy. And so those two things make the equivalent of a standard homeowner's policy. And just going back to rates, I mean, so obviously we've had a lot more losses, and we're finding, they're more and more expensive to rebuild, right, in the state. Because the way it stands right now is California is unique. We have Prop 103 that basically limits how insurance companies can set their rates in the state. And it doesn't operate like this in other states. So they have it's a more unique model here to protect consumers, but with the repeated risk and rising damage, the insurance companies have basically said it's not sustainable for us. State Farm, when they said no more new policies, you have to understand they were writing 20% of the policies in the state. While there are 100 plus insurance companies writing policies in the state, no one had that level of market exposure the way they do. And so for them, it's a threat to their business model.
Does that suggest that there's less chance of the other insurers pulling out and don't have as much exposure to State Department? Does that mean we're actually going to, the market forces, I guess that goes to the economist question. If there are 100 people writing insurance and a couple of the big ones pull out, will the other ones have a financial incentive to stay in some more policies?
Well, first, so California, there are like 100 insurers that are admitted. The term is admitted to write insurance in the state, but it's more like 12 are currently writing new policies. So
writing new policies is different. And
right,
then there's the surplus lines, which are non-admitted, which are not guaranteed if they go bankrupt.
That's
so
you can give.
So, but my point is that even if State Farm pulls out, that stops writing new policies, the environment has still got to be attractive to a smaller company, another company, to write that policy. And so, they've got to have the rate flexibility to do that. So it really depends on, can the carrier get the rate that they need? So going back to your sort of question earlier about, will there be coverage? I do think overall the insurance market's pretty competitive. There's a lot of companies out there. There's a lot of capital. There's a lot of retirement plans that want to invest in insurance. So it seems like there's a pretty competitive, I don't know if innovative is the right word, but a market. And so you'd expect that given the right premiums, that there would be coverage available. Yeah, exactly. And then let me just say one more thing. And then the FAIR plan, the issue with the FAIR plan is that if the FAIR plan runs out of money, they assess all the insurers in the state for their shortfall. So that creates another problem for insurers. So because they're subject to this quote assessment risk that they'll be assessed. Yes, that's another factor. It's not just the premiums. They have which happens in other states too, like Louisiana, Mississippi, and Florida. But this risk, this is called the risk of being assessed by the FAIR plan, and that can be a significant factor for insurers deciding whether they want to write in the state. So you don't want the FAIR plan to get too big and be too large. So you really do want the it's called the voluntary market, which means the insurers voluntarily write this policy to thrive.
Run that risk of having your policies. We've only got a minute or two left. If we had more time, I would go into the idea of what happens when you do get dropped. But Valerie, this card that you passed out has information and a link to where there's the word dropped in big red letters on it. There's more cards up here if you need one about what to do if you actually get dropped. It's much different from seeing your rates go up or not getting a policy on a new place, right? So that's tremendously important. I want to thank both of you for taking the time to do this and helping us understand something that is so hard to understand. We'll do an 8-hour version of this panel next year with a quiz and some curriculum. But thank you both for doing this.